Global food markets are shifting under pressure from wars, weather, and policy shifts, and the FAO Food Outlook flags rising risks that could ripple into prices, wallets, and supply chains. From export bans to droughts, uncertainty now travels faster than a shipment on a container ship. This matters because billions rely on affordable staples like wheat, rice, and maize, and small changes hit households hardest in developing economies. Investors watch weather forecasts, crop yields, and logistics bottlenecks the way coaches study game tapes. Understanding these dynamics helps explain why insurance costs and grocery bills may move together. The next few seasons will test policy resilience and consumer budgets alike. FAO Food Outlook summarizes how global food commodity markets are balancing supply and demand amid a widening set of risks. In plain terms, harvests can be strong in one region, while drought and conflict tighten belts elsewhere, pushing prices higher for staples and fattening the volatility premium across crops and proteins. It tracks production forecasts, stock levels, trade flows, and nutrient needs, then translates these into scenarios for price paths and availability. Think of it like a weather forecast for calories, where a storm over one bread basket can ripple through bread and feed costs worldwide. Markets respond to harvest totals, policy signals, and freight costs. Background draws a line from post-war grain corridors to modern supply chain financing. The FAO has tracked price spikes and bumper harvests for decades, but risk has mounted with geopolitical frictions in major exporters and with climate extremes becoming more frequent. In the 2007-2008 food crisis, prices surged on drought and panic, then subsided as supplies rebalanced. The late 2010s saw biofuel demand and trade liberalization shaping markets, while 2020s brought pandemic disruption followed by Russia-Ukraine conflict and sanctions. Understanding this history helps explain why today shifts feel incremental yet cumulative, altering hedging strategies and long-run investment theses. Current market impact shows volatility premium rising across softs, cereals, and oils. FAO notes that prices for benchmark wheat and maize have fluctuated within tighter ranges than last decade, yet remain elevated relative to pre-crisis norms. Traders price weather risk and geopolitical disruptions into futures curves, prompting hedging activity from food processors and feed producers. Freight costs, fertilizer prices, and energy proxies add to moves, widening spreads between nearby and deferred contracts. Consumers feel the ripple as retailers adjust margins and importers juggle inventory. Markets also push volatility into currency and bond markets as risk appetite shifts, with headlines stakeholders span farmers, traders, manufacturers, and fund managers. Farmers face price swings that influence planting decisions, fertilizer budgets, and credit access, especially in drought-prone regions. Food manufacturers contend with input costs that can jump quarter to quarter, pressuring margins. Exporters face policy chatter from governments, while importers wrestle with currency risk and inventory lean times. Asset managers and pension funds increase allocations to soft commodities as inflation shields, while specialized commodity funds seek correlated yields. Retail investors watch futures markets, exchange traded products, and commodity equities as proxies for inflation hedges and diversification during geopolitical storms. Small traders also adapt by using options and liquidity pools to weather surprises. Geopolitics and macro trends frame risk in multiple layers. Sanctions and export restrictions disrupt flow from key bread baskets, while shipping bottlenecks and energy prices influence input costs. The dollar's strength or weakness affects import prices for commodity-dependent economies, amplifying or easing inflation pressure. Global growth projections moderate demand for higher value foods, but population momentum sustains long-term consumption. Climate policy, fertilizer supply, and crop insurance regimes shift production incentives. Meanwhile, central banks balance inflation control with growth, creating a tug-of-war that filters into commodity markets through risk premia and capital flows. Trade policy signals also tilt investor expectations and discount future harvests. Smart money leans toward diversification and inflation hedges. Institutions build exposure via commodity indices, energy-linked funds, and agricultural ETFs, seeking correlation with real assets rather than fragile equities. Banks price loans against crop yields and weather models, while insurers hedge catastrophe risk with index products. Retail investors crowd into broad commodity ETFs or futures because the FAO Outlook hints at persistent volatility and potential supply shocks. However, clever players also look for quality crops, geographic spread of farming risk, and timing discipline, avoiding crowded trades when sentiment shifts to risk-off mode. They monitor fertilizer prices and freight routes as early signals. Case scenarios center on cascading failures in supply, demand, and policy. A surprise drought in a major wheat belt or a shipment disruption of fertilizer could tighten world stocks faster than anticipated, triggering panic buying and higher feed costs. A sharp energy shock or a renewed sanction wave could fuel inflation that erodes consumer demand and forces currency depreciation, destabilizing hedges. If climate events intensify or trade blocs constrict, price spikes may become persistent rather than temporary, undermining affordability and triggering social unrest or political backlash that further restricts supply. Investors worry about liquidity drying up, and a double hit to farmers and processors. Retail investors can approach this cautiously with a clear plan and risk controls. Start by diversifying across a basket of soft and hard commodity exposures rather than chasing a single hot theme. Use long-only, hedged, and option positions to balance potential upside against drawdowns. Emphasize quality exposure in crops with strong yield resilience and geographic diversity to reduce region-specific shocks. Avoid over-leverage and set stop-loss ideas. Track weather models, fertilizer prices, freight rates, and central bank signals to time entries. Maintain liquidity to adapt quickly as FAO forecasts shift and headlines evolve. A rule: never allocate more than a small portion to high-volatility assets today. Looking ahead, FAO forecasts and weather patterns suggest a world where price volatility remains a feature, not a bug. Supply risks could heap pressure on staples, while demand remains resilient in many regions, supporting a floor for prices even as shocks occur. Investment clarity will come from disciplined risk budgeting, diversified exposure, and vigilant monitoring of crop conditions, shipping lanes, and currency moves. If you want practical updates on how these factors play out week by week, subscribe and follow the Commodity Brief. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.